So once again, good evening, everyone, and thank you so much for coming on time. We were just waiting for the people to join, and I think while the rest of the people will join, we'll continue and start the session today. My name is Yogesh, and this webinar is powered by Century Financial. We are an investment consultancy, and we assist our clients in understanding financial markets, helping them with research and training to strategize portfolios, and at the same time we continue to assist and aware you about financial markets through webinars like this. This is something which we do every week, 10 days on different topics, and you can always go to on our YouTube channel and visit the previous webinars which we have covered in different topics and about different events which has impacted the markets. Today, we're going to discuss about how we can plan our portfolios for the coming second half. I'll give you an estimation of what is expected in the 6 months. Of course, we all know that it's really difficult to predict what is going to happen, but um, the research which comes to you and the information which you see, it is the job of an analyst to draw conclusions and draw predictions from the information which we currently have and what is expected. Of course, I'm sure a lot of you will have questions about your investments as well, and please feel free to use the chat option to and ask those questions. I'll try to answer them while we are in the middle of the session, because that would clear your doubt and help you to go more smooth in the session and ask more questions. And any questions which I cannot answer, my team will definitely reach you out and will make sure that your questions are answered. Right. So while we begin, please understand that whatever we are going to discuss about, it is for information purposes. And while we talk about the expectation of how markets are going to perform, in no manner I'll be guaranteeing or assuring any kind of returns, because the financial markets are always risky, and we need to make sure that risk management needs to be effective, diversification needs to be effective, and rest uh, picking the right asset class, picking the right direction, that is what it matters. um, at the end of the day, our job is to make sure that we diversify enough, we spread our money into different asset classes which are not correlated to each other, and in a manner where the risk is minimum, and of course everybody is seeking higher rewards. So, moving on and understanding that what are the mid-year outlook takeaways, what we are going to understand here. Just to put it in points, the global market rally is expected to continue. So we are looking at the equity market across, and I'm mostly talking about global market rally when I say talking about US stocks as well, talking about European equities as well, but mostly about US market a lot, because um, we have seen a rise in the tech stocks. We have seen overall rise in the stock indices as well. If you have observed, whether you talk about the global benchmarks in S&P 500, you talk about Dow Jones, or even the small cap index, we have seen a certain amount of growth happening. So it is expected that this market rally will continue. AI impact could be massive. Artificial intelligence, as we always talk about. I also am logged in my live platform, and I'll be able to trying. I'll try to show you the recent rise what AI stocks have seen, and again where we see them in the next 6 months. Higher rates may not be permanent, so we'll understand about what is the Federal Reserve looking up to this summer, and then by the end of the year. And then US elections are going to be really significant, because this is the year of the US elections, and we have seen back in the past that markets have always reacted in the most volatile way and very sharply whenever we are talking about US elections. The geopolitical risk could continue, and I think something very disappointing and very unfortunate, but I think this is something which has been happening for some time, and less likely to end this year. So yes, we have to plan our investments around these events, and we have seen that what happens when the geopolitical risk becomes too strong. It impacts gold prices, it impacts crude oil, it impacts stocks as well. And this is something which is not very unprecedented. Like, it's not something which can be predicted that when it is going to end. So far it is expected that the geopolitical risk could continue. Now, before we move on further, let's just understand what has happened. Markets in the next 6 months, and as we call it as a mid-year in 2024, it is not expected that there will be a recession. In fact, in case of US markets, we are talking about a soft landing. But yes, the data, the economic data which is coming of lately, that has um, made sure that central bank delay the rate cuts, and this has created slightly some risk of a harder landing in 2024 or early 2025, because earlier it was expected that the rates will be higher, but there will be some rate cuts. And for those investors who have joined for the first time, or if they're not aware about the rate cuts part, very quickly to make you understand, uh, in United States, whenever the inflation is higher, in fact, in every major economy, whenever inflation increases, the cost of lending or the interest rates which one pays during taking the loan or borrowing the loan, those interest rates are increased to ensure that people have less money in their pockets and their demand comes down and the price of the product comes down, so inflation comes down. And whenever inflation is too low, the central bank uh, cuts these rates to make sure that people have enough money to spend. So inflation needs to be kept under a target of 2% is what is anticipated. And this percentage was much higher 1 year ago, 1.5 years ago. And due to excessive rate hikes, excessive increase in interest rates, now this inflation number has come down. But still, central bank struggles to find out that is this inflation uh, okay, or we should wait for a target of 2% to come. And that is the reason why the central banks are not reducing rates anymore. Just imagine this way, that at this point of time, loans are expensive, and everybody is vouching that these loans become less expensive or cheaper, and that would boost stock markets really high. Along with that, gold prices, and along with that, every other currency which is paired with dollar. So this is the reason that why interest rates are one of the most key and important thing when we look at the next 6 months. So when we talk about the soft landing part, soft landing in US was supposed to be that a fewer rate cuts, no recession or a mild recession, and that would be okay. But now, because the first few rate cuts which were supposed to happen in US are not happening due to the economic data in US, which has come actually better. We have observed that enough jobs are being generated in US. We have seen that inflation still continues to remain slightly higher, and that has pushed central bank to make sure that everything remains the same. They don't want to make this mistake where they cut rates and again inflation increases, and then again they have to increase the rate, because that shakes up the confidence of the economy, and it affects the stock markets as well. So this is what has been observed. There is still no clear answer to this year's key question, that is US economy headed toward a very softer or a harder landing, right? Because the idea is, are we looking at a recessionary period? Are we looking at a slowdown? Or are we looking at uh, less of a slowdown, but more of a rate cut and more of an increased economy? So again, as we have seen that there has been no clear answer to this, there is enough evidence that economy is slowing, inflation pressures are easing though. So there has been a, in spite of a little slowdown in the economy, we have seen that inflation pressures are slightly easing. A lot of households, though, they have exhausted their pandemic excess savings. I'm sure that there are a lot of people who try to save money during the pandemic. And back in 2023, there was a lot of fiscal boost. Now those savings have been exhausted a lot. And again, this is where the main debate is, that is there going to be a recession in US, or it is going to be a very mild recession and the markets would move on? Because right now the economic data which we see, they aren't much of a help, because slowdown signs can be uh, it could be a healthy rebalancing that allows inflation to cool down. Because sometimes what happens is when prices, so I'll explain you this manner. Sometimes what happens when prices are too high, a lot of these companies, they're selling products at a higher cost, so their revenues are increasing and their earnings are looking better. But when this inflation cools down and the prices starts coming down, at that particular time we observe that the earnings of these companies have reduced. Now that reflects in the economic data, that earnings have reduced, but that doesn't mean that economy is suffering. That just means that inflation is cooling down, and that could be a good idea and could be a good news for the economy. So at this point of time, this is what the analysts are trying to understand. And economic data cannot be just a lower economic data cannot be observed as a sign of slowdown. In fact, it could be inflation which could be cooling down, and that could trigger negative growth. But then again, that is something which will still be counted as a soft landing, and that is something which a lot of people would be vouching for. Now, let's try to understand what we are expecting in the asset class preferences. Now, here, if you see, we are looking at the asset class preferences, and I'm showing you the year till date. So, January 2024, performance of all these indices, and this includes China as well, this includes UK as well, this includes NASDAQ as well, Japan as well, and these are percentage returns which we are looking at. And this has been since the beginning, January 2024 till June 13th or June 14th is the data. And as you can see, the world growth index is up. You look at NASDAQ growth, look at Japan index, look at S&P 500, and look at gold as well. So these are the asset classes, and this is January 2024 till June. This is the current scenario which you're looking at right now. And if you see, uh, as it says that the global stocks in the first half of 2024, the returns have been actually very good. Because if you see Nasdaq has gone up by 18%, S&P 500 almost 14.7%, and if you see even Chinese index is up by 8%, UK is up by 7.7%. And in this, if you further see, and when we show you further details, you will see that most of the growth which has occurred, especially in US indices, that has been because of the mega cap 7. And mega 7, as we call it, uh, Apple, Google, Nvidia, as we know that it continues to shine, stronger demand for computing technology, a stronger demand for processing units, and they have declared really great earnings. And over a period of quarter on quarter, they continue to perform well. Now, there are some smaller companies also, which are again more vulnerable to the interest rates. Uh, and at the same time, they have also continued to perform. The small cap index, if you see, it has went sideways, if you see in mid June. But if you compare and look at the large cap performance, the large caps are much higher at this point of time. There is, if you see on the chart itself, and if you see bonds slightly here, just at the end, you will see that there has been a lot of volatility in fixed income markets. And it is very high because central banks, they are not able to come to a decision where the rates need to be cut or not. So every time an inflation data comes or a growth data comes, bond market is really volatile at the moment. The bond yields have rose sharply through mid-April, because inflation figures in April were much higher in US, and that was the reason why that central bank cut down. Central bank, which was supposed to cut rates, have delayed that rate cut. So this is something which it basically took a U-turn, and what was anticipated in the summers that US will do rate cuts, it did not happen, and that is why we saw there was a slightly decline in the stocks as well. But as you see, since January till June, the US stock market still continue to appear higher, and that is what we need to understand. Government bonds are attractively valued, and if we see, currently, if you buy a US government bond, you will be receiving at least 4.5 to 5%. And that is the coupon which you receive on yearly basis. This was the reason that why a lot of equity investors, they still are not uh, uh, allocating enough amount of money in stocks, because when you compare the risk and reward, At this point of time, the return on the US government bond is around 4.5 to 5%, what they call it as a risk-free return. Of course, it is called risk-free return, but here I would use the word relatively less riskier. So the current performance of the indices has been good, while bond markets have been really volatile. For those investors who like to have some fixed income, I think government bonds still is something which can be the part of your portfolio. And please remember this: the bonds and the interest rates, they have an inverse relationship. Between 2021 or between 2022 to 2023, central bank increased rates at least 11 times, and during entire time we saw the bond prices dropping in. And now bond prices have come down so much that a lot of investors are still flocking in to buy bonds, because central bank of US has hinted that there could be a rate cut, but by the end of the year. It was supposed to happen this summer, but because of the higher inflation and good job numbers, Fed has decided to continue with the current policy, which is not a very loosened up policy. But maybe by the end of the year, there could be one or two rate cuts, and that is why a lot of people are still continue to buy bonds and holding on to it. Now, let's try to understand the regional snapshots of what is expected from these particular countries. So, we're looking at US. Now, again, the mid-year outlook is very firm. Labor market has rebalanced to 2019 levels, right? Not very overheated also, but then there has been inflation. uh, if you see the personal consumption expenditures, that is again something which has been moderated to a 2.6%. See, when we look at numbers, what we understand is the labor market is still very strong, right? I'm not going to bore you with the percentage numbers, but just to summarize, in when we look at US, right now the Fed will start carefully cutting rates, but it will happen later this year. Now, September was expected the most likeliest timing for the first move. If you see the earnings of the companies, the Q1 has been really good. All the top tech companies, they have declared very good earnings. We saw profits stabilizing for the broader S&P 500 companies also, even the smaller market value companies. Now the idea is most likely US can avoid a recession this year, but again uncertainty is higher. But again, as I said, that they could avoid a recession this year. And there is some risk, um, if the Fed does not cut rates, and that is something which we are going to know in September. Markets, most of the US markets, they are already priced in for a mild recession if it comes across. But one thing which a lot of people have, I mean, this has been a very open discussion, and I'm sure a lot of you will agree with this. Markets are not the same like it used to be before. Earlier, something, if a news comes like rate cuts are not happening anymore, that would create a lot of chaos in the market. Now it's not like that. Now investors have become more optimistic, and they have absorbed that volatility. They have become more stronger, and that is why now you don't see that shake up happening every time a central bank comes up with a different news. And that is good. That's good news, because this shows that market psychology now, that there's a lot of investor optimism. Again, not a very extreme level of euphoria at the mid-year, not a very sharp risk. But then I think the bond still remains very volatile. The central banks would remain data dependent depending on how the economic data comes. uh, any bonds, and again this is for my those investors who like to have fixed income idea, bonds over the medium term, any good value bonds, and I'm talking about good quality bonds, as we say, medium term to short term to medium term bonds could be a decent idea, because in terms of real yield, it could be a good idea to diversify whichever economic scenario comes in. If the interest rates increase due to higher inflation, you still have the bonds. And in case if the rate cuts happen, which is a much likely anticipation, um, that could increase the price of the bond. So a capital growth can also be anticipated. So I think for US, we are still expecting a soft landing, not a recessionary period. Corporate earnings are doing well in the first quarter, and this is July. So next webinar which we are going to do will be on again the corporate earnings and how do we trade in the earnings. So, and I think possibility that even this quarter earnings could be decent. So overall, for fixed income investors, short to medium term bonds could be a good idea. Uh, there is a idea where you can get coupons as well. Plus, if the value of the bond goes up, you can sell it in the market, and that is also something which can be done. Now, moving on to the UK markets. Now, UK outlook is beginning to improve. If you see the consumer confidence, business confidence, it's rebounding. Housing prices now are beginning to recover. Inflation is still there, and that has stopped Bank of England from signaling any more rate cuts now. So at this point of time, I think if you see the Bank of England's target for inflation, which is 2%, they are getting closer to it. And again, we are talking about elections in UK as well. And this is also something which is going to bring some chaos. We are talking about Labour Party, which is running a very cautious campaign. And there should not be any substantial changes to taxation or government spending. So I think overall the UK outlook is more improving. If you see in the chart which I showed you, the UK index, it has at this point of time a very attractive PE ratio and a good dividend yield. So at this point of time, for example, if you are buying a UK index, there is a 3.5% dividend yield on the UK benchmark index also, which is UK 100. And at the same time, if you see the price earning ratio of the index, price earning ratio, for those investors who are not aware about this, the price of a stock, and we divide it by the earning per share to see that whether the stock is undervalued or overvalued. If the P ratio as compared to the average industry is less, that means the stock is undervalued. You go for a buy. If it is higher, then it means it is overvalued. Again, there are a lot of parameters to it, but I'm just trying to make it more easier to understand. Now, in case of the UK 100, the PE ratio is very attractive and looks like a decent buy. And given that what is anticipated in UK, they are closer to their inflation target, so that could be a good sign. And another very important thing which we discussed about, that it has a 3.5% dividend yield. If you look at UK bonds, they are also very attractively valued right now. 10-year bond yields right now is 4.1% uh, yield, which is being given to you. So in case of fixed income, US bonds, UK bonds again are there. US bonds are giving you around 5%, UK bonds are giving you around 4%, and could be a mix of your portfolio. Again, to every investor, I would definitely request, do not stick to just one instrument. The key is always the diversification. It does not matter which asset class you're looking at, but if you're diversified across, sometimes even if you have not given much thought and you have still invested, there's a fair chance that you might end up in a net return, because some of the other asset classes could have worked out. But if you're focused on only one specific asset class, that could be a bigger risk, because diversification at the end of the day needs to be there. And that being said, one of the major economies which we have been looking at recently, European Central Bank did a rate cut also, and we have seen German index slightly moving higher and then coming down. Euro has been moving a lot between 1.06 to 1.07, 1.0750 levels. Now, outlook for Eurozone, again, if we see the economic data, the industrial activity has picked up. If we look at the inflation from European Central Bank also, they have, so ECB was the first one after 2023 to cut interest rates by 0.25%. No other economy did. ECB did first. And now it is expected in the next 12 months, again, there could be another rate cut for at least 1%. Recent parliamentary elections have generated still some political turmoil due to the right wing populist parties. They have succeeded. So we have seen some sort of political turmoil happening. French president. They called the election. The National Assembly government was formed. It created a lot of fears in France. So if you see the French index itself and a lot of eurozone equities, European stocks did come down around 4 to 5%. Right? Again, if we still feel that the European stocks are attractively valued when we compare to US, because for the longest time Germany was in recession and we have seen the German stocks coming down. It can rebound, but there is a lot of political drama. So that is something. Economic conditions are improving in Europe, but there is a lot of political drama. So you need to again diversify with US, with UK, with Eurozone, and that is the reason why we need to be very aware. Please be informed about what is happening around the world. So if you, as I said, I talked about Eurozone. Economic data is coming really good. Industrial activities have started picking up in Europe. Rate cuts have started in Europe. All of this basically signals to a decent equity market for Eurozone. At the same time, the bond prices, the German bond prices, were down in 2023. And right now, due to rate cuts, we might see an increase in the German bond prices. Then you can take an exposure in just the capital growth of that particular German bond. And there is a whole basket of such bonds, which is called Eurobuxel, and we have that product in the platform. You can always check. So this is also something which we can always see. Apart from your normal um, day trades or long term buy and hold, there are a lot of opportunities which comes in the middle, and that is why it is really important that we must diversify into this. Japan, as you saw that in the chart, that Japan has also, the index has moved really higher. For the first time in 17 years, we saw that Bank of Japan raised interest rates. This almost had not happened in last 17 years. And the forecast is that most likely the rates will go up. Economic outlook in Japan looks still very decent. Manufacturing is picking up. The Chinese outlook is also becoming more supportive. Uh, if you recently have observed, and if I get the opportunity to go to the live chart, dollar has become a lot more stronger than yen, and yen has continued to depreciate. And the depreciated yen is supporting a lot of inbound tourism in Japan right now. If you see the government bonds in Japan, they are very unattractive because again the valuation is not that great, and given the inflation expectation, I don't think that Japanese government bond is something which you could look at. But then if you see the corporate earnings, they are expected to do better. And the stock index of Japan, this has priced in a lot of good news. So again, that is something which you can look at. Japan as an economy is doing well, and I think I don't know how many of you actually have Japanese stocks or a Japanese index in your portfolio. Use your chat options to tell me if you have any of you have exposure in Japan through a fund or through an index. It's a yes or no question. I don't want you to work too much on this, but if you have, just share it with me, and will be a great point of discussion. Again, guys, whatever we are discussing today, you're most welcome to have a one-on-one discussion later on once the webinar ends. In the coming next week, I'll definitely be available and just talk to your RMs. And if you want a one-on-one understanding or a one-on-one training session on the platform or any strategies, or you want to understand about more about this outlook, we can definitely sit and discuss for you. Since you have become the part of this webinar, so your entire access is free, of course, so you do not need to worry about it. Moving on to the Indian economy as well. Again, India has been one of those growth stories, and it will still continue to. India has been surging. If you see growth in India, this is already, there are a lot of mega trends which have emerged. Uh, Digitalization, if we talk about global offshoring, if we talk about energy transition, if we talk about, and these are some ideas where we have seen the consumer and the businesses have started spending. Morgan Stanley has forecasted around 6.8% growth in 2024, 6.5% next year. Inflation will still stay in the comfort zone, nothing too high. And there's a very stronger global growth which is predicted in India, and again leading to a higher income from exports and supporting domestic capital spending. Faster than expected recovery and a stronger business environment is expected with the Indian economy. So that is something which is good because India is an emerging market, and I think a lot of my clients, they really invest in Indian equities as well. My request and my suggestion to everyone is always have a diversified exposure. Yeah, like if you're an Indian and if you have that liking that I want to invest in India, by all means do that, but do not neglect China, do not neglect Japan, do not neglect US. In fact, make a portfolio which is diversified into all of this. So if either one of the index is not doing really well, you could look forward to other markets. Let me just show you in this manner the chart which I showed you, right? Look at this. In this, if you see, Nasdaq has moved up 18%. It's a US index. Japan has moved up 16%. S&P 500 again US gone up 14%. Gold prices, commodities moved up 11%. And if you see again UK market 7%, and emerging stock index fund around 6.4% increase. So this is important. Why? Because if you see all the different markets, if you had invested in, if you had only invested in emerging market funds, you would earn 6%. But if you had invested in US as well, Japan as well, you would earn 18% separate, 16% separate. And that is what is important, right? So please diversify, and that is what helps you manage the risk as well. When we are looking at the asset class outlook, we are looking at commodities, fixed income, and equities. These three are really, really important. And let's understand this. See, uh, we have realized that how the current gold prices have moved a lot higher. And if we were to see in commodities as a risk mitigating assets, gold still continue remains the only direct commodity exposure which could be held in portfolios. Gold as a commodity is very volatile, but let me tell you, gold is also a safe haven asset, which means whenever the investors are troubled or in fear or in panic and they're selling stocks left, right, and center, there's a war situation or a pandemic or a certain uncertainty, people tend to buy more gold. So while you are bullish on the equities, while we discuss more positive scenarios, uh, taking a trade in gold could be a risk mitigating asset also. So you could do it directly using the commodity, or there are a lot of gold ETFs, exchange traded funds, through which you can take exposure in gold also if you don't like to see too much volatility in your portfolio. Elsewhere, I think it is better. Apart from gold, I think silver prices have been completely undervalued for the longest period of time. I'll also tell you a strategy called gold silver ratio later on, once we sit one on one, and I'll tell you that how you can neutralize the impact of metals or commodity movement in your portfolio. That is slightly higher risk, but then again, nothing which cannot be managed using the research. And next we move on to the fixed income part. Again, if we talk about fixed income, I think a lot of value is seen in the developed market government bonds, like I talked about US and UK bonds, and that could be a good hedge against the volatility which is happening, right? If you're looking again, please in corporate bonds, higher quality segment is really preferred. Please do not go after high yield bonds. Don't think that. So a lot of times companies which issue bonds which are not doing really well, they provide higher returns on the bonds because there is higher risk. At this point of time, it is important that you only invest in high quality segment quality bonds which are less riskier. Slightly less return would work, but do not go for more riskier bonds. Exposure needs to be very low in terms of if you're looking after any high yield bonds. Okay, if you're going forward for higher income, please keep a very low exposure, a higher exposure in good quality fixed income bonds. I think that should be something. And I would say the same thing for equities also. Like if you look at a long term investment philosophy, the entire portfolio should always be more focused on high quality, cash generative and conservative businesses, right? Again, there will always be tech companies which you can always put money in, but do not shy away to buy bonds, buy stocks which gives you fixed income also. So there are companies like Coca-Cola, there are companies like McDonald's or Vodafone or Verizon or Starbucks. These companies, they give you a good dividend as well. There's a question here. Would you upload the? Yeah, we definitely put this webinar on the YouTube channel as well. So you can always go back to our YouTube channel and you can always revisit. And we have a lot more other webinars also uploaded back in the past. So you can definitely do that as well. Now, as we discussed, that the Fed probably won't be delivering any interest rate cut this summer, and this summer is what we are talking about right now. But when we see now in the next 2 or 3 months, and starting September, we might see Fed started cutting rates. So that is something which investors should be looking forward to. And European central bank was the first one to cut rates, and they did. And now by December it is expected that there could be 2 to 3 more rate cuts in Europe, and that could really increase the price of Eurobuxel, which is the basket of German bonds. As I said, that there's an inverse relationship between Eurobuxel and the European interest rates. And I will take you to the live platform before we end this session. I'll take you to the live platform and show you that how this trade can be placed and what you can do. So coming to the last segment, which is strategies now. So how do we need to plan our portfolios around? First of all, as I said, good quality stocks and good quality bonds is very important. Do not go for riskier companies or riskier bonds. It is important that at the time of chaos, only the good quality companies they survive. So look for companies which generate higher cash, which are high quality. Talk to our consultants, and you can definitely get a portfolio made for yourself. And this is something which can be done. Second is Eurobuxel, as I talked about. On the This is the play on the current interest rate. Let me show you on my live platform what this chart looks like, and I'll show you that, see over a period of years that how it went down and went up, and what this particular product is. So I'm going to just share my tab here. Okay. Now here, if you see, I've shared my screen. If you can see my screen clear, guys, just send me a thumbs up or a yes or a okay, so I can continue. This is just the last segment of the session, so I don't want anybody to miss out on this. If you can see my screen properly, please send me a yes or a okay, so I'll continue. Okay, perfect. Okay, I think most of you can, right? So I'm going to tell you one product, and I'll try to explain in the most easiest manner. In case if you even don't understand, if you have more doubts, as I said, doors are open. Please visit us anytime. We are at Imar Square. Come for a cup of coffee, sit with us. We are based here locally, so you can always come with us, and we'll discuss these products with you as well, and show you the risk and reward part as well, that how this works. So I'm talking about a product called Eurobuxel, right? Let me open this for you. Now, if you see this product, this is currently. So, what is Eurobuxel? First of all, Eurobuxel is a basket of German bonds, long-term German bonds put together. What is a bond? A bond is a product which is issued by a government or a company. In this case, it's a government of Germany. Bond is a product which is issued by a government when they are in need of money. So what they do is they issue bonds, and if I, as a bondholder, buy the bond, I'm basically giving a loan to the German government. They will use my money for a limited time period, and they will pay me back my principal amount at a specific date, which is called maturity date of the bond. Along the every year, while they use my money, they will pay me a fixed interest, which is called coupon on the bond. That is why bonds are relatively less riskier than stocks, and the client always have a mix of this in their portfolios. Stocks are companies. When we buy shares of a company, we are more like business partners. We are not lenders. So we do not get a fixed coupon in a share. We could get share out of the profits, which is called dividend. That also, if there are profits and if the company chooses to pay the dividend. At the same time, in case of bonds, it is mentioned that by the end of every year, I will receive a fixed interest on the money which is being used by the bond issuer. So when we are buying bonds, we actually are creditors to the government. When we are buying stocks, we are business partners. So the risk is higher in stocks as compared to bonds, and the income in bond is fixed and relatively less riskier as compared to shares. Now, when I say a basket of German bonds put together, you can see that there are German bonds which are issued, some are issued for 25 years, 30 years. Whenever the government of Germany need money, they would issue bonds and tell people to buy these bonds. And when they buy these bonds, people give money to the government, and in return, that bond has a maturity period. And once that maturity period comes, the people who have bought, the bondholders who have bought the bonds, they get their money back along with a fixed coupon or a fixed income which comes year on year. That is why a lot of people who are closer to the retirement, who do not need too much action in their portfolio, they just look for fixed income, they buy bonds and hold on to it. Now the product which I'm showing you, uh, this does not give coupons. This is just a play on the interest rates in Germany and the price of the bond. As we have discussed before, that there is a inverse relationship most of the time, which we have established, that whenever the rate cut happens in an economy, the price of the bond goes up. Now, to show you the chart how this basket has reacted, I will just take you back only 2 years ago, right? Consider this as this is the price chart, but to make it more simpler, instead of showing you here as candles, I'll just show it you as a line, and that should be better. Okay. Now look at this, and I'll just show you since 2023 and even from 2022. So if what you see here, this was March 2022, right here, or July 2022, just 1 year ago. Sorry, 2 years ago. And if you see, this is when the European interest rates started going up. And if you see this, the European interest rates started going up. Look how low the bond prices started coming down. So when the rates were going up throughout 2022, look how much down this went. And this is the basket of the German bonds. Okay, this was at 182 euros. It came down all the way to 136. In 2023, if you see, it went up 163. Entire 2023 again, if you see, because Germany was into recession and rates were still higher, look at this. It went down all the way to 117, right? Even further down. This high which was achieved, this was back in 2020, because rates were very low and bond prices were going up. Inverse relationship: when interest rates are low, prices go up; when interest rates are high, prices come down. And see how 2023 has been for this. This has hit 117 euros from 180 euros down, this low. And then now in 2024, when there was anticipation between October to 2024, there was an anticipation of rate cuts, the prices went back to 145, and then again over a period of time we saw coming down to 126, right? Now, when ECB has announced, look at this spike from 125 to 133. This happened when rates were cut recently by 25 basis points. Again, it has come down, prices have corrected, people have booked profits. But this is a long term play for those investors who don't like to see too much action in their portfolio, but they're moderate risk takers. If you like to see some sort of capital growth in the portfolios, but in a less riskier manner, uh, Eurobuxel could be that product. That being said, please consider, this is not a risk-free idea. Okay, this is not a risk-free product. This has risk. There is a possibility that if Europe does not cut rates, the price might continue to come down. It did go down to 117. So please understand this. It used to be at 200 euros and it came down to 125 or 117. So you must understand, obviously, this happened over a period of 1 year and 2 years. But now we are somewhere where we stand at the bottom of this chart and we look at the interest rate environment in Europe. Since Germany is in recession, there is no motivation for Europe to increase any more rates. Plus, the rates in Europe are higher in 25 years that has ever been. So all the economic data, all the signals, they're indicating that there should be more rate cuts, and by the end of the year it is expected 2 or 3 rate cuts to happen in Europe. And that is why a lot of investors are buying this basket now, because expecting a capital increase at least to go back to 143 or 144, right? This is just one part of the strategy which you could do in your portfolio. But see, this is apart from buying bonds, earning fixed income, buying stocks, getting dividends, buying tech stocks, trying to earn capital growth, at the same time doing your day trades, your mutual funds, whatever you do. I'm just giving you one idea. If you feel that, okay, I want to take that action, 1 or 2% of your portfolio you want to put into this, it could be put into this one strategy also. So this is called Eurobuxel strategy, and you can always try to do this. Of lately, there has been, and again, so there has been a seasonality analysis also, and I'll show you something. And this is something which is again much more detailed, and you can definitely look at this as well. So this is called seasonality analysis, where we analyze a trend for a particular product, and when we analyze that trend, we go month on month to understand that how this product has performed. And that is why this is something which becomes much more detailed. And before we end this session, would like to show you one thing. I think there has been, yeah. This is again a scenario analysis, not a seasonality analysis. I'm sorry. One second. Seasonality. All right. So let me show you first the scenario analysis in Eurobuxel, the strategy which we just talked about. Right. So the strategy which I just spoke. So this is Eurobuxel, right? As I said, that this is the underlying the basket of bonds. Now look at this price chart. What I was just showing it to you from last 2009 till 2024, talking about easily 15 years. And look at, in 15 years, this is where the current price is. This is the red line which is there. In last 15 years, this is almost the support level which we have reached at. And look at the highest, it has been above 220, 230 euros, right? So over the past decade, the lowest recorded price is 116, highest was 240, and currently it is between 126 to 128. So even if your target is 136 or 150, this is something which you can do, because the daily movement, the volatility is around 2%, 1 to 2% on day basis. So this product moves around 2.5 euros every day. So still, a lot of people who do this is slightly less riskier than those day trades, could be a part of your moving portfolio as well. So this is what the analysis is anticipating, that if there is a decline in the rate by 75 basis points, which is 0.75%, Eurobuxel prices could go up by 14%. And if there's a decline of 1.5%, it could go up by 29%. But at the same time, as I said, this is not a risk-free strategy. So in case if at any situation the rate increase happens, that could be terrible, because that could again lead to a decline in the prices by 14 and 30% also. So you take that risk. Obviously, if you want to put a stop loss, you always can, but this is more of a medium to long term strategy rather than a very short term speculation. So this is also something which can be done. A lot of platforms do not provide this product, and that is why it is important that you must see this. One thing also which I want to show you over here, and this will be the last uh, of the things when we speak here. This is not something which has been, I mean, this was some sort of research which we were looking at it. Yeah. So for this, what I showed you was a scenario, but I also want to show you a sort of seasonality. This, I just took a snapshot from Bloomberg. and I just thought that this is something which, if we can look at this, let me see if I can share this on my screen. Mid-year. Okay, I'm just going to um, yeah, okay. So I'm just going to share my screen for this one, and you can have a look here. So we'll get an idea of. Just open a preview. So I hope everybody can see right now what I am seeing. This is the Euro Buxel seasonality chart, and this has been just pulled from the Bloomberg. And as we see, and this is since 1999 till 2024. What seasonality helps us to understand is that how which month most of the time has showed a pattern where it appears more positive or negative. Now if you see this in the entire uh, from 1999 till 2024, almost 23 years, if you see July most of the time has been into green, and this is what is the current month we are talking about. September most of the time we have seen appearing in red. Rest patterns are much more random. But if you see July, there have been returns of 13%, 5%, 4%, 3%. Most of the time it has appeared in last 25 years. Only 7 or 8 times we have seen this going in red, and the returns have been much, the negative returns must have been around 2.2 or 3.6 or 1% or 1.4 or 3%. Maximum loss has not increased more than 3.5%, while the returns have been 13%, also followed by 5% or 3%. So this is also something which we are capable of doing. Research is something which needs to be the core of your portfolio, and that is what we try to bring in when we are trying to show you that how this needs to be done. um, I was actually showing a chat, maybe due to the screen sharing. Yeah, I was not able to discuss. Perfect. So what I was trying to show you was basically the 25 years of trend in Eurobuxel, and it has been observed that July has been more positive. But I'm definitely willing to sit with you and share these things one on one. So, guys, for today, the idea was to just to sit with you and give you an understanding of what you could do in stocks. One thing which we have, which I also want you to focus on, something related to artificial intelligence. Right, this is something which just the last thing I wanted to discuss about, because artificial intelligence growth debate has been going on. Is it a hype? How much AI could potentially boost the GDP growth? That is the question. So it has already resulted in the cost structure improvements of a lot of firms. So if you see, for example, computer programming, coding, this has dramatically increased the productivity. uh, Still these are early days for large language models, but we should not forget chat gpt has come across. It was released 18 months ago in November 2022, right? So again, there is the gap between the people who are negative about it and the people who are very positive about it. It is again about the proportion of tasks that can be done by AI on cost effective basis. So a lot of people are very optimistic because gains are much more efficient in some industries. The speed at which work is done and the improvement it is occurring now. So benefits of AI will likely lead to reallocation of labor and new tasks, and this is a cost saving measure. So again, this is something, if it is a possibility that technology eventually will result in boosting productivity. There are several implications because increase in the growth should lead to a higher equilibrium in interest rates. If we look at taxation, we look at distribution policy, we look at the productivity boost. I mean, AI basically favors capital over labor. So corporate profit margins should be supported, right? There will be a lot of capital employed to bring AI into the business. So how that is going to affect the earnings is of another question. But at the same time, a lot of cost is being saved. So AI is also something we need to understand how much contribution of AI will come into GDP. Long-term GDP trends are determined by the growth in the working age population and productivity. And if the around the demographics, when we see the aging, if it is increasing too much, will it give it rise to the productivity, or will uh, AI basically cut down the cost and make things more productive? So there are a lot of growth optimistic, and a lot of these optimists, they are seeing a green signal for the exponential advances in AI, and that is why you need to take this thing much more seriously. So there's a question here. What about silver? Seems that price has not gotten up like gold. If you see, so there is something called gold and silver ratio, and this is something very interesting. Just divide gold prices by silver, and you will get a number, mostly around 74 or 75. If you will see that over a period of time, this ratio did go up with gold prices going unnaturally higher and silver coming down, and it reached to 84 and 85, and after that this number started coming down. Silver initially did not go higher as high as gold did, but in last few weeks we have seen silver outperforming gold in terms of percentages. Yes, silver has a very industrial application. While gold continues to be the safe haven asset, silver has, since you're talking about it, there is something I would want to share on silver as well, and that was something which we talked about a few weeks ago, and this was done specifically, I think, on the silver part itself. So as I was talking about, silver is more of an industrial metal. So it does not react to the uncertainty part of it the way gold reacts. In fact, if there is an expectation that there will be a decline in the manufacturing, most of the time this would affect silver in a negative manner, right? That being said, we were doing a lot of analysis on this, and this is something which I want to share with everybody since a question has been asked here. This was done more for people who are interested into a different kind of product. But since we are talking about this, just have a look at this. Only the outlook part is important, which you need to see. Silver catching up to the gold's bullish cycle was the idea. Now, see here, what we realized, the regression analysis between gold and silver in the last 10 years and the correlation which we were looking at. And yeah. So basically, we prepared a product where if there is a potential breakout in silver above 30 levels in the next 3 month period, you could be able to capture the upside. And if it does not fall below 26, you will be able to protect your portfolio. This was done through a structured product. But what I wanted to show you was this particular correlation between gold and silver in the last 10 years. One second here. Yeah. And as you can see, as per the regression analysis, it has been around zero 0.8 or 1.396. And this is something which we have observed for a long period of time, that earlier gold and silver still move in a similar direction, but the rate at which one outperforms another is something which is really, really important. uh, Last few weeks we have seen silver prices outperforming gold, whether it is in case of downside or in case of upside, and it did catch up with it. But a lot depends on how the further global economy will carry out. Gold, in case of, because US elections are coming in, geopolitical tensions are still there, less likely that silver will be able to outperform gold. And it will still be, as far as I give you an outlook on commodities, that most likely when it comes to risk mitigation, gold should be the only commodity which could be the part of your portfolio. That way, silver has rallied already. So just to share the chart with you. Yeah, just to share the chart with you for silver. If you see here, okay, just going to change it to a line chart. Look at this. So it's not like it has not moved higher. Look at this 2024 entire scenario from 22, and again look at this dramatic increase from 26 all the way to 31. This is good for silver. But if we go back years and years ago, you will see that silver has been pretty much stagnant throughout. Look at this. The range has been very much, this is the support which has always been there. I'm looking at last 2021, right? Even if you go much, look at this trend. Look at this channel right here, right? This is what a support has been, and this is where most of the range has been, and then it has given a breakout. So at this point of time, I think silver is above its channel, but how far it's going to go, it will depend on the economic data also. Because if manufacturing declines and if it doesn't do better, then we may not see the demand for silver to be enough, and that is also a much important factor for silver prices to go up, right? So gold, better to be in the portfolio in the form of a ETF, could be a great idea. Not if you don't want it directly as a commodity. All right, guys. So I think there are some questions regarding the demo account. Yes, you can get the demo account as well. Can I conduct a one-on-one session? Yes, I can. Just talk to your RMs, and they will definitely direct you towards um, the idea that how can we conduct one-on-one sessions. If you want to come down to the office, we can have a session customized for you. Definitely, please just find a time and let us know. We are working um, since 10 a.m. till 9:30 or 10 in the evening. Anytime you get some time, please come, and we can definitely sit and discuss more about this. Right. So thank you so much, guys, for sitting through this. I know 1 hour is a very, very long time, but again, this is not everything, but this is just a gist. Let's try to sit and discuss and understand that how you can draft your portfolio accordingly, looking at another 6 months. Please diversify. Please manage your risk well. If you're a day trader, please put your stop losses. Talk to us for more strategies, whether it is aggressive, conservative, moderate, short term, medium term, long term. We are investment consultants, so we can try to make different strategies for you. Just like what I showed about Euro Buxel, there are a lot of market neutral pair trading strategies which we can sit and discuss, and I can explain you in a better manner. Please, if you like this session, definitely review us on Google. It really motivates us to keep doing these sessions every week. And go on Century Financial Google review. If you have any feedback, if you liked it, if you didn't like it, please do give us the feedback, and we'll definitely try to work and improve on it. So once again, thank you so much. You have a good night. We'll see you next week with a different topic around the same time. Till then, be healthy, be safe. Um, just one question before I leave. We do have a CFD platform also, and we do have a session. We have a CFD platform. We have a platform without CFDs also. Whatever you like. If you want to own the stocks, you can. If you want to have trade in CFDs, we can do that as well. Right. So once again, guys, thank you so much, and I'll see you next week.